Very good. Let's begin with exercise 11. And we've got, let's see, we want to have $30,000 in the future. So our future value is $30,000, but we've got 4 different scenarios. Each one has a different interest rate and a different number of years. So using Excel, what we could do, if we want to calculate the present value, take this all, paste it in here. If you recall, you need to enter your amount in a negative number. So we'll make that negative 30,000. I'll just do a Control D to copy that down. And then how can I get Excel to calculate this present value for me? Where do I start? Function, okay, insert function. We want PV, not NPV, but PV. Okay. Click OK. And then I could either enter it or select the cell, right? If I enter it and then I try to copy that formula down, it's not going to know how to change the different variables for the different rows, right? So if I put 0.09 and I copy that down, it's going to still stay at 0.09. But if I select, see, can I just click there? Oh, I didn't even have to click this little box. I just clicked there. And then number of periods, which column is that going to be? Time. Okay, so time. And payment, what's that going to be? We're going to leave it blank. All right, good, good, good. This is a trick question. And then our future value is future value. Okay, and then we don't need to put anything under type. Again, we can see it's already done a calculation for us. Click OK. It automatically rounds it to the nearest penny, which is nice and convenient. Then you just do, again, Control D, and it copies that formula down, automatically adjusts the interest rate and the time based on whatever's in those fields. Let's do it in Google Sheets. So let's paste in the same data here. Pretty much the same steps, just, slight variation. So where would we start? Actually, let's put our minus sign over there. I forgot about that. Okay, so where do we start?
Functions.
Okay.
Also, could you just do equal and then type PV?
Let's see. PV, tab to accept.
And click enter.
I don't know. Working. Present value. Oh, okay. That worked. That worked. Cool. And we can basically do the same thing. Rate is our rate. Then what do I do to get it to show me that little legend again? Comma. Number of periods is time. Comma. We don't want to put anything for payment amount, right? So we'll just do comma again. And then select future value. Enter. Check mark. Nice and easy. The way I usually do it is I'll use this function button, but Zay's approach works too, equals, and then PD. Great, so we've got our answers. Copy these, we can go back here, highlight the fields we want to paste it into, and it goes right in. Nice. Not so bad, right? That was a lot bad. And it looks like we got that all correct. Any questions? Okay, so number 12. Our friend has a trust fund and it will pay her the following amounts at the given interest rate for the given number of years. Calculate the present value of the trust fund payments, okay? We could do this a couple different ways. We could use a table. Which table would we use in this situation?
Value of annuity.
Present value of an annuity, because our friend's going to be getting this annual payment, so it's an annuity. And we're trying to figure out what it's worth in present day dollars. So present value of an annuity. We could also use a spreadsheet. So what's your choice? How should we do it? Spreadsheet, probably be quicker. Okay. All right, well, we can take our data, take it over to Excel. Now we've got a little problem here. See how it says 5 years? Excel's not going to like that. So let's just change that to 5, 10, 15, and 20. It'll like that better. All right, and then to calculate the present value, what should I do next? Okay. Click our function button. Again, we want PV. Yeah. Rate is here. Number of periods is here. Payment, are we going to use payment in this case?
Yeah.
Yes, because it's an annuity, we'll use payment. We're not going to use future value because the FV would only be if we were getting one lump sum in the future. But since it's annual payments, we're using the payment instead. Okay, then we can click OK. Ah, it gave me a negative number. Why did it give me a negative number? Exactly, because I gave it a positive number. So let's go ahead and make these negative. Oops, oh, come on. Let's try that again. Okay, when I change that to negative, it automatically made the answer positive. Okay, so we'll go ahead and do that with each of these here. Okay, now I can just copy down my formula. And we have our answers. Let's compare in Google Sheets. Take the same data over to Sheets. And we need to prep our data. Oops, 10, 15, 20. And make these negative. All right. And you can use this function button if you like. Go to Financial and PV. Rate, comma, time, comma, payment. Enter. and check mark. So now we can take these answers and paste them right there. Okay, looks like they all came out right. It's not so hard, right? A lot easier than trying to do it manually. Any questions? Right. Okay, we didn't do 13, did we? You did. Did we do it?
Yeah, we did.
Oh, we did it the other day?
Yeah.
Okay. Okay, well, we won't do it again then. All right. 14.
Number 12, precedent.
Number 12, sure. Yeah, those are long numbers.
How is it rounded? In like the answers, is it rounded up or is it rounded like that?
No, I think it's exactly like this, but let's double check. Yeah, exactly the same.
Okay.
Okay, everybody set? So number 14, how much must be invested now to receive $30,000 for 10 years at an 8% interest rate? So which table would we use to solve this? Figure out how much to invest today. Except that this is $30,000 per year. It's not real clear, but that's what it means, 30,000 per year for 10 years. So it'd be present value of an annuity. Let's go to that table. Present value of an annuity. I think it was 10 years, 8%, right? So that's 6.71. $10, 8%. Yeah, so 6.71. We're going to multiply that by the $30,000. 201,300. Well, okay, this came out with 201,302, but either answer is fine. I prefer it's a matter of what table you use. Because again, this table only goes out 3 places after the decimal point. So if you use a table that goes out 4 places or longer, then you're going to maybe get a slightly different answer. So basically what this means, if you invested $201,300 today into something that's giving you an 8% interest return, you could take out from that investment $30,000 every year for 10 years. So you're basically putting in 200,000 and taking out 300,000, right? So you're making $100,000. Assuming you can get the 8% guaranteed interest, you know. So to solve that, we did use the present value of an annuity table. It gave us a factor of 6 point whatever. We multiplied that by our annual income, and we got our investment amount. So any questions on 14? Okay, 15. This project costs $5,000 and will generate $1,800 a year for 5 years. We need to figure out the NPV with an 8% discount rate. So how do we do that? Since it's even cash flows, it's probably easier just to use the table. Which table would it be? It is because it's $1,800 a year. So it would be an annuity.
So it's 1,800 a year for 5 years.
Yeah, again, it's not really clear. It says $1,800 for 5 years, but they mean 1,800 a year for 5 years. So do we need the present value of an annuity or future value of an annuity table? Present value, because we're trying to get the net present value, right? Makes sense. Okay, so present value of an annuity, it was 8% in 5 years. That was 3.993. So we'll take that 3.993 factor. What do we multiply it by?
Would you do 6,800 and then subtract your stake?
1,800. It's just the 1,800. It's just the cash flows, because remember the $5,000 is already in present value. That's the money we're going to invest up front, right? So what we have to do is take the annual cash flow of 1,800, which is every year, so it's an annuity, discount that back to the present value, and then subtract the $5,000 investment. So we take our factor from the table, multiply by the 1,800 a year. So that gives us 7,187.40. That's the future value of that 5 years of cash flow. And from that, we subtract our $5,000. We get 2,187.40. Oh, they probably rounded off. Let's take a look. Yeah, 2,187, close enough. Okay, so remember, NPV is a two-step process. Find out the present value of those cash flows, and then subtract your investment. Okay, ready for 16? Oh, did we do 16? We must have done 16. Okay, we did. Somebody did it. Okay, then we're going to do 17. So now we're getting into IRR, which again, we're only going to use spreadsheets to calculate IRR. Here we have an investment of $420,000. So that is year 0. And then we have cash flow of $95,000 per year for 5 years. Okay, so year 0 is $420,000 going out, and then we have $95,000 coming in for 5 years. So let's take that information over to Excel. And we have an IRR function. So if I just type IRR and go, you see there's an IRR function. All we need to do here is select the values starting with the investment. There's this guess feature, which can help calculate it a little bit more quickly, but it's really not going to save you any time. I guess if it were a super complicated calculation, if there were just a ton of data that it had to sort through, if you had an approximate guess, it would speed up the process a little bit because it kind of knows where to start. We really don't need to worry about that, so you can just skip that guess column, and we can just click OK. Now notice it gave us 4%. If we want a more detailed answer, you can go up here, click this little left arrow button, and it'll move the decimal point. So you get more places here after the decimal point. So we see more specifically, it's 4.25%. So this project, where we put $420,000 in, we're getting back $95,000 a year. It's generating an internal rate of return of 4.25%. Any questions? Okay, let's do the same thing in Sheets. So you can really click anywhere you want, doesn't really matter. Again, we're going to go function, financial, IRR. Just select the fields all the way from the investment through to the last year of income. Enter. Again, it rounded it off to the nearest percentage. For some reason in Sheets, these two arrow buttons are opposite compared to how they work in Excel. So in Sheets, if you want to see more places after the decimal point, you have to click the right arrow. But you see, we get the same answer. So IRR is pretty simple. Let's move on to the next exercise. 18, it's another IRR. So here we've got a cost of $308,000. Then we've got uneven cash flows, 88,000, 92,000, 91,000. Oh, wait a minute. Oh, I see. 72,000 and 71,000. Okay, so the data look like this. You can do the exact same thing we just did. Go into Excel. Function, IRR, select the data, enter, and then the left arrow 2 times, we get 11.28%. Actually, did I forget on the last one? Let's see. Okay, 3rd time's a charm there. I forgot to put in the answer. It was 4.25%, right? Okay. And on this one, we just got 11.28%. And if we want to see an instant replay here in Sheets, take our data, function, financial, IRR, select the data, and then we click the right arrow 2 times, and we get 11.28%. Yes, Elvie.
What number do we put for campus? Do we put it 11.28 or 0.11?
That's a good question. You wouldn't put 11.28 because that assumes that it's a percentage, right? But we don't want to make that assumption because Canvas isn't going to understand that. So you would put 0.1128. Okay. Yeah, thank you for raising that because I sometimes forget to remind everybody about that. Ready for 19? All right, this company is considering a project with an investment of $265,000 in new equipment, annual net cash flows of $45,800 over 7 years. minimum required rate of return is 8%. So here's where we have to use that backwards method to figure out what percentage this is. I guess we could probably do it with a spreadsheet, but let's do it with a table just for kicks, to see what it comes out to. Okay, so if we take our $265,000 investment, divide it by our annual cash flows, we get a factor of 5.786. Then we're going to go to the tables. This is going to be the present value of an annuity table. And we're going to look on the 7-year row. 7-year, and we're going to look for, well, what do you know? 5.786, exactly right. So here on the 7-year row, we found our factor that we just calculated. We see that that is a 5% internal rate of return, but it said that the company required an 8%. Should we accept the project? The answer would be no. Right? Because it doesn't meet that 8% requirement that the company set out. And let's try just with Excel, just to see if we come up with the same 5%. How would we do this in Excel? How would we figure out the IRR? It's kind of hard to say IRR.
You did the investment.
Okay.
As an error number, and then 7 columns of 45. 45,100.
Okay. We'll copy that down. There we go. Okay, so we have 7 years of 45,800. We have our investment. We can see what is our IRR. 5%. Okay. All right, any questions on that one? All right, so number 20, investment of 256,950. Returns of 90,000 a year for 4 years. What is the IRR? Okay, we'll do the same thing. Yeah, it is. IRR. Exactly 15%. Okay. Okay, here we've got a piece of equipment that costs $55,898, lasts for 5 years with net operating cash flow of $14,000 per year with no salvage value. What is the IRR? So let's try it with the table method just to see what happens. So we take the investment divided by the annual cash flow, 3.99. 5 years. So we go to the present value of an annuity table, 5 years. There's a 3.99. So our IRR is 8%. Clicking on the wrong thing. 8%. All right. Any questions? All right. Well, then let's move on to the problem sets. did 4. Okay, so that leaves us 3, 5, 8, and 10, unless we did any of those. I don't remember. I know we haven't done 3. So using the tables, it says answer the following questions. Okay, so I need you to help me on this. Figure out which table we're going to need in each of these situations. First situation, we want to accumulate $2,500 over the next 4 years. How much do we need to deposit today? Which table would that be?
Future value.
Future value of $1. Okay, we'll come back and actually solve it, but let's first figure out the tables. Second is we place the money in a savings account. We want to know how much we're going to have after 7 years at a certain interest rate. Savings account.
Are you just placing it in once?
Yeah, I guess so.
And then it would be future value of $1. The first future value of $1.
The first one is present value. Yeah, first one's present value. Yeah, second one is future value. Okay. Right, because in the first one, that's how much we want to accumulate. So we already know the future value. We need to figure out present value. Second one, we know how much we're putting in. We need to figure out the future value. Okay, that makes sense. And C, we invest $8,000 per year. How much will we have at the end of 10 years? So what would we need for that? Future value of an annuity. And through process of elimination, we could probably guess the last one's going to be present value of an annuity. We win the lottery. We can either receive a lump sum, which would be today, or we could use this, we could receive this future value. So we have to discount that back to the present. So that's the present value of an annuity. Okay. All right. So we're going to use all 4 tables. We're going to start here with present value of $1. It's 4 years, 15%. Here's 15%. 4 years is 0.572. And we are multiplying that by 2,500. So we need to invest 1,430 today to equal 2,500 in 4 years. And let me know if you find that 15% interest rate somewhere. Let me know where you find that. Okay, the next we need future value of $1, 7 years, 12%. Is the 12% column. Go down to 7 years. Our factor is 2.211. What do we multiply that by? 6,200. And we get 13,708.20. Okay. Next one, future value of an annuity. It's 10 years, 12%. Go to the 12% column, go down to 10 years, 17.549. What do we multiply that by? 8,000, right? The annual amount. So that's going to generate 140,392. Not bad. If you're putting in 8,000 for 10 years, that means you're contributing $80,000. It's turning into 140,000. And the last one, we won the lottery. Congratulations. And we can get 750,000 today, or we could get 50,000 a year for 20 years. So if we didn't factor in the time value of money, 50,000 times 20 would be $1 million, right? Sounds like that's a better deal. Let's go ahead and discount that back to today's dollars, and let's find out. 20 years, 8%. Present value of an annuity. That would be a factor of 9.818. Multiply that by the 50,000 a year. It has a present value of about $500,000. 490,900. So the question is, which do we recommend? We would recommend take the lump sum, because the annuity has a PD of 490,400, which is less than 750,000. Right? Because we could take that 750,000, put it into some kind of investment that's earning 8%, and it's going to be worth a lot more than $1 million. Well, that's true. Either way, it's going to be taxed, right? Okay. That's it. Any questions on number 3? I think next is 5. Okay, here we go. Okay. So let's see, this company is going to buy a patent that costs $50,000. So that's 50,000 going out in year 1, or actually at year 0, I should really say. So there is no factor. Then we're going to have cash flows. You can just ignore this net income column, because what we're concerned about here is the present value of the cash flows. So we have 17,050 is the cash flow in year 1, 18,450, 18,250, and 14,850. So I'm just copying down these cash flows here. Then we need these factors. This is trying to, again, get the present value. We're trying to get the net present value. So we need the present value of a dollar table, and it's 8%. So present value of a dollar, 8% column. We need the first 4 years factors. 0.926, 0.857. Then we have 0.794 and 0.735. And what do we do next? Multiply, right? Oh, I seem to remember on this one, I think this might be the one where they, for some reason, went out 1 more digit. Let's see. All right. Yeah, I don't know why they did this, but they went out 1 more digit. They must have been using a different table. So you know what? We're just going to cheat a little bit. Why do all the work if we're going to get a different answer, right? Here I am. There we go. Okay, so that is the official answer for part A. So the net present value comes out to $7,006. Part B asks us if the required rate of return increases. In this case, it was an 8% required rate of return, right? So if that goes up, what would happen to the net present value? And if we take a peek back at the table, we were in the 8% column, right? If we go to the 10% column, you see the numbers get smaller. So that's what the impact on the net present value would be. If the interest rate went up, the net present value would be lower. Any questions on problem 5? Okay. I see some people still taking notes. I'll give you a moment. All right, so then we have problems 8 and 10. Let me peek at 10. The 10 is going to be a quick one. 8 will take us a couple minutes, but we're pretty much on track here. Okay, did everybody get what they needed on problem 5? Yeah. So this pizza place has 2 choices. They can keep their delivery vehicle they have now, which is kind of an older vehicle, or they could get a new one. So we need to compare these 2 options. They give us the data here. If we're going to start with keeping the older vehicle, if we do that, let's see, we're going to have to pay $8,500 in repairs now. Oh, actually, in this case, there's no revenue. We're only looking at costs. So we could just keep it consistent. I'm going to just enter them all as positive numbers, but just keep in mind that these are all costs. If we were mixing revenue and costs, then we'd have to do it differently. So $8,500 going out in the first period. So that's a factor of 1. In year 1, we have annual cash operating cost of $12,500. And that's going to be the same every year, except in year 5, we're going to sell the vehicle for $500. So I'm just going to decrease the costs from 12,500 down to 12,000. We have to put in our factors here. We can cheat on this one a little bit as well. Copy it right from here. Okay, so now we have our initial cost for the repairs and then our annual costs. And we'll multiply that. Is that right? It doesn't look right. Oh, I guess so. Okay, that's right. Then we're going to multiply every year. Let's see, are they rounding? No rounding this time. Okay. Okay, hopefully I did that all correctly. Let's add it up and see what we get. $53,279. That is the cost if we keep the existing vehicle. Okay. Excuse me. Our other option, we sell this vehicle. We can sell it now for $5,000 and get a new vehicle for $31,000. So if we do that, that's going to be a net $26,000 cash outflow, right? It's $31,000 going out minus the $5,000 coming in. And again, that's a factor of 1 because it's happening now. Then our maintenance costs per year are going to be $10,000. And at the 5th year, we'll sell that new car for $5,000. So we have $10,000 a year. Then in the last year, $10,000 minus the $5,000 we get from selling it. So that's a $5,000 cash outflow. We can use these same factors and just do the math here. This is nice and easy, actually. It gave us nice round numbers to work with. And except the last one. Okay, and we can add these up. $59,215. Okay, so we've done our 2 NPV analyses here. Based on what we came up with, should we keep the old car or buy the new car?
This is the only thing that's determining it is not a new car, because it's slightly less.
The new car?
Oh, I didn't see that it's just not that big right now.
Yeah. Yeah, so the old car?
Yeah.
Yeah. So if we repair the existing vehicle is the better option if we're only looking at MPV. Okay, any questions? Might go a minute or 2 over, but we're just about done. Does anyone need additional time here on this? God bless you. So our last one here is problem 10. So this restaurant's considering a new oven with a $60,000 cost. Okay, so that's $60,000 going out. It'll generate $9,950 for 8 years. Required rate of return is 6%. So again, the tables in the textbook don't have a 6% column. So I don't know why they gave that to us, but I did provide this alternate table. Same thing on problem, I don't know, there's another problem in here where there's a link to an alternate table. Okay, and we do have a 6% column here. So we need 8 years present value of an annuity, because this is money that they're going to be generating every year. So 8 years, 6% comes out to 6.2098. Going to multiply that by the 9,950. We get 61,787.51. However, we have to subtract the initial $60,000 investment. And that gives us 1,787.51 remaining. So we do have a positive NPV. So we should buy the new oven. Right? If it were negative NPV, we would not want to buy the oven. And that's it. Questions? Okay, well, have a good rest of the week, everybody. See you next week.